So I'm currently recording this on Monday 13th of April, so things may change, but today we'll see if the stock market has bottomed, and if yes, is this the opportunity to go all in and invest our money for the next bull run? I really recommend you to watch this video until the end because that's where everything will make sense. Literally every single piece of the puzzle will come together, and I'll also show you a personal analysis of the stock market, what could happen in the near future. So coronavirus has affected the stock market hugely. Everyone knows that. The stock market dropped 34% in a month. Now what's more impressive is the speed at which it happened and basically the volatility that came out of it. So let's look at the three deadliest fatality in the stock market so far. So on the 9th of March, which was a Monday, the Dow Jones fell 2,010 points, which was 7.8% drop. Many people call this the new Black Monday of 2020 as it was the worst drop in terms of points for the Dow Jones. Only 3 days later, on the 12th of March, the Dow Jones fell another 2,300 points in a single day. So basically setting a new record that was just set 3 days before. 4 days later, on the 16th of March, the Dow Jones set again another world record and lost 3,000 points in one single day. So that's a 12.9% drop. It's actually bigger than the Black Monday from 1929, which was 12.8%. However, to put back a bit of perspective into all of this, you need to understand that the higher the price of the stock market, the more points are less valuable in a sense, because they represent a smaller percentage because the price is higher. So it's true that in terms of points dropped, we have set 3 world records for the stock market. But looking at percentage, we still have not beaten the 1987 crash, which resulted in a 22% drop in a single trading session. Now, I don't want to bore you with what caused the stock market to drop. I think you've heard the word coronavirus enough in the media. Before any of this virus outbreak arrived, equities were already jittery and in a quite vulnerable place as Trump launched a trade war with China. The other clue we had that things weren't so right before the pandemic was given by the yield curve. So to make things super simple, a yield curve is simply a graph where you see what return each investor is getting compared to the bond maturity. So how long they have to keep their money invested in that bond. So for instance, I'll issue you a bond and you'll lend me money for a month and I'll pay you a small interest for that because you know I probably won't fuck up anything and I'll give you your money back in a month. Now, if with this same example, I tell you that I'll give you your money back in 10 years, you will ask me for a bigger return simply because you know that in a period of 10 years, there's a higher chance that I'll fuck up something and I won't be able to pay you back. So a healthy yield curve is when short-term maturity bonds pay less than long-term maturity bonds. So here is, for instance, an example of 2014 where you can see that short-term maturity bonds don't pay as much as long-term maturity bonds because the risk is much higher when you go on longer timeframes, longer terms. Now, obviously, the rates of returns investors are getting per maturity bond changes all the time. So that's what causes the yield curve to actually move. Now, what happened in the beginning of 2019 is that that yield curve that usually goes up, as you've seen in that example, started inverting. So returns on short-term bonds were actually higher than returns on long-term bonds. And as you know, usually more risk, more return. So what does that tell us? That shows that investors think something may fuck up in the short term, and that's why they're asking for a high return than the long term. And this only happens when the near-term risk is higher than the longer unknown future. Now, to give you an idea of how powerful this inverted yield curve is, it has literally predicted by inverting the crisis of 2008, 2001, 1991, 1981, and now it seems it's predicting the 2020. So we're getting through the analysis slowly, and this brings me to my main point. The combination of a stock market crash plus an inverted yield curve can signal a recession. Now, a pandemic slows economic growth. In the case of COVID-19, it's another fucking level, right? The global economy is on lockdown, shut down, whatever you want to call it, and we have never ever seen that before. So a market crash, an inverted yield curve, and a pandemic can easily trigger a major recession. Now, the average recession lasts about 11 months. So I'm honestly laughing when I see people saying that the stock market downfall is ending and now is the opportunity to buy after only one single month. I mean, anything is possible, but you need to look at the probabilities, okay? That's the average. At the moment, we can see we are very far away. What could happen? The probabilities are not for it to end now, okay? As a trader, as an investor, we need to act on probabilities and data. We should not act on sentiment. And in my opinion, it currently seems a bit early to see a full stock market recovery. If you look at past recessions, the biggest opportunities, so the bottom of the stock market, happened when people were totally discouraged, no one had any money, and there was literally blood on the streets, as Warren Buffett says. Currently, I don't feel like there has been enough blood on the streets, okay? People are literally sitting at home watching Netflix, and most of them are getting paid for it. We are also seeing many small retail investors pretending to be Gordon Gekko in these timeframes and buying the market as they think it has bottomed, and they really don't want to miss that next recovery, as we've seen in 2018, 2019, where we were literally making new highs every single week. So what we are currently seeing, I think, is a move of FOMO, so fear of missing out. People do not want to miss the next bull run, that recovery. But guess what? The small retail investor rarely makes any money out of the stock market. So I believe that now is the time where all those mini Gordon Gekko get onto the market, will get fucking crushed, and will sell at lower prices to the big fish. Now I know many of you have been waiting for me to analyze the stock market on the screens, on the charts, and look at the technicals, so let's dive in. But before that, I'll give you some time to like this video and subscribe to the channel. So to analyze the stock market, we'll have a look at the S&P 500, as it's the index with the largest market cap in the world. So it shows what is happening on a global scale. So this is what the S&P 500 looks like on the chart. This is just a normal chart, and as you can see, prices are exponential. That's how the stock market moves on long period of times. So we can also look at it on a log chart, which you may know that mathematically, but that's how you look at exponential charts, and things make a bit more sense, okay? But we can see that the move we have seen compared to what has happened in the past, let's say 30-40 years, is not that impressive, even though it is still a down move. So the first study I will want to make is timing, okay? We know that a bear market usually lasts between 1 year and 2 years, so specifically between 11 months and 22 months, okay? So let's look at this. We've seen that this downfall has started on February 2020. We are currently in April 2020. So probabilities are this move has not finished, okay? And I've actually put some lines in for you to see when would that potentially finish. So this is the average end of a bear market, and that would be quite a long-term bear market. Now the next study we will want to make is how far do bear markets go, okay? So the average bear market is about 36%, and the craziest bear market, if we forget 1929, was 2008, okay, which was 54%. So let's put that on the chart as well. So as you can see, this big line here is what would correspond to a 36% drop of equities from the highs, and this is a minus 54% drop from the highs. So by using these two simple analyses I just gave you, we know that the probabilities of this bear market are to end between these two levels, okay? We know that the bear market is probably going to end around here. We also know that the bear market will probably end in these areas, okay, between the average 36% and the maximum of minus 54%. So if we add this plus this, what does that give us? It gives us that magic square, okay? So I am personally expecting, and it's not because I have a crystal ball or whatever, I'm literally expecting S&P 500 to reach basically this box simply by probabilities. So maybe it'll reach just here, maybe it'll reach here, maybe it will reach here, I don't know, but that's the probabilities for it to end here. Now let's look at the common continuation pattern that we have seen during crisis, okay? So as you know, the S&P 500 currently, and what we are seeing here is the S&P 500 during the 2008 crisis, okay? So what can we see? Since the major drop, okay, we've seen prices literally come down, then correct with a very nice corrective trend line and drop, okay? Another very nice move up with a corrective trend line and down, corrective trend line, down, okay? This is literally the pattern we are seeing. Down, correction, down, correction, down, correction, with very clean trend lines. What we are also seeing is that these corrections tend to use Fibonacci levels, okay? So Fibonacci levels is just an area where correction tend to end. So as we can see here, we had this major drop, then a sort of ABC correction, okay, we'll see that later, which ends around the 50% to 61.8% fib level, then break the correction trend line, and then we are coming down. Exactly the same here, okay? As you can see it, ending at the 50% fib level, breaking that corrective trend line, and then we are down again. So we know that this was a common continuation pattern with fib levels in 2008. So now let's just look at the 2020 drop we are seeing, okay? What are we seeing? We've seen that drop from beginning of February, okay? And we see that A, B, C correction with a very nice trend line, okay? People that have been trading will remember this. And we had that major drop, okay? So that happened once. What are we seeing now? 1, 2, 3. So that A, B, C, you see I've put it back. Fib levels, once again, you can see we are rejecting the 50% fib level. And if we break this trend line, okay, remember, we are always seeing that A, B, C trend line. If there's a break, we are seeing that other impulse down. I believe we should see that other impulse down, okay? Remember also, we have not reached at the moment, or even prior to that, we have not reached the average bear market length, first of all. We have not reached the average bear market depth, okay? So this is probably the move that could actually take us there, okay? Which would be something like that, okay? This would literally take us to our zone we were expecting, and then a bit of sideways movement will give us that golden square we were looking at. Now, the other reason why I think this is not the stock market bottom and we will not start making new highs from here is simply for the fact that if you look at, for instance, 2008, okay, so we've seen that very common corrective structure, okay, that we are currently seeing again now. But what are we seeing in the reversals? We see that the reversals are super clean. So if you do trade and have a very small knowledge, you'll know that this is an inversed head and shoulder, okay? So what does that tell us? This is actually telling us that sellers took this down here, sellers came back, sellers again, buyers, and at this level, basically, there was no more sellers, okay? Here, sellers were gone, so buyers that came in at higher levels are taking control of the market, and that's when basically the whole correction, the whole recession was ended. So a very obvious and clean reversal pattern. Now, if we have a look at the crisis from the 2000s, we'll see that it ended in a very similar way, okay? What are we seeing? How did the 2000 crisis, 2000 bear market end? Same, with a triple bottom, which is a very obvious reversal pattern, okay? As you can see, here, buyers came in. Buyers came in again, buyers came in again. From that point, you could see sellers here, sellers here, sellers here. And from that point, no more sellers. That's when the buyers are taking over the market. That's when you want to be with the buyers and prices going up. That's how it ended. So you can see very, very similar to 2008. And that's how recession ends, with a very clear reversal pattern. Now, looking at 2020, this is a daily chart, so the exact same time frame as we were looking in 2008 and 2000s. We are not seeing that very obvious reversal pattern that we have seen in 2000, 2008, okay? This for me is exactly what we have seen, so the continuation pattern that we've seen over and over and over in bear markets, okay, with that ABC. And you can see from basically my technical analysis that this is what I'm looking at, okay? We have literally seen that bounce up to the 50% level, okay? ABC, right here inside of this, let's say, rising wedge. We also had that trend line which was broken this morning, retested. So yeah, I mean, if we break this corrective structure, I think we could see more downside from the stock market. And as I've tried to explain as much as possible, this is not me guessing anything. This is just me giving you the probabilities where it should end, where it should get to, and what we have seen in the past, in order to predict what could literally happen and to try and react and yeah, make money out of it. So I'm giving you all this very valuable information for free for you to understand that you can't play this investing game just by listening to what the broad media is saying or listening to your friend Bob, who's actually broke, by the way. So if you found this video interesting or valuable, please share it on social media, also tag me, and I'll see you in the next video.